The KPIs that got startups funded a few years ago aren't the ones that investors care about now. So growth alone isn't enough, and some of the old favorites are being challenged hard. In this video, I'll walk through the metrics that investors are actually focused on today, and by the end, how to decide which KPIs matter most for your stage of growth. Hi, my name's Alysha Randall. I'm a fractional CFO and I'm also an author of Financial Leadership Fundamentals, How to Become a CFO in a Startup or Scale Up. And if that sounds interesting to you, then please click on the subscribe button below. So the venture capital landscape has shifted, and unfortunately, it hasn't shifted back. So the period of cheap money is well and truly behind us. Interest rates are higher, and fundraising takes longer, and investors are far more selective about where their capital goes. So for startups and scale-ups, that has really changed how performance is measured. So maybe it's not necessarily looking at extending runway or slowing hiring, but rather it's changed the KPIs that matter in the boardrooms, in investor updates, and fundraising conversations. So why the old metrics aren't enough anymore? So for a long time, growth was the headline, and that's all we needed to focus on, along with perhaps the customer acquisition cost, CAC, and lifetime value. While these are still important, they don't really dominate the discussions in the boardroom. So founders focused on month increases in a single North Star metric. So that might be users or transactions, GMV, MAUs. As long as the chart was pointing up to the right, then all the other questions were secondary. Those metrics, they still tell part of the story, but they no longer prove the business health. So what investors are looking for now is evidence of discipline. And that's not saying that growth isn't still important and that ambition of growing the business, but it's in a controlled environment. So not just momentum, but resilience. And that means that the KPIs have evolved. The metrics that matter in the current environment. So the first one I wanted to touch on was revenue quality, not just growth. So annual recurring revenue, or ARR, has become central for SaaS businesses, but this thinking also applies well beyond subscriptions. So even if you don't run a SaaS model, investors do now want to understand how much of the revenue is genuinely repeatable or sticky, what portion of the revenue is predictable, and what relies on constant sales and marketing effort. And being able to separate the two, so reliable revenue from effort-driven revenue, is really important, particularly when you're fundraising in a tougher market. It's much easier to tell potential investors that 80% of your revenue is pretty much guaranteed for the next 12 months, and the final 20% takes a bit of sales and marketing effort rather than the other way around. Efficiency growth. So burn multiple has become far more common discussion point, and this looks at how much cash the business burns in order to generate each unit of new revenue. So unlike CAC, which often sits narrowly, it's basically a sales and marketing metric, burn multiple reflects the efficiency of the entire business. So in an environment where capital is expensive, inefficient growth is penalized quickly. So you want to be able to grow as fast as you can, but as efficient as possible. Balanced performance measures, the rule of 40 has become a SaaS benchmark to a general shorthand for balance. So high growth with no regard for losses is no longer enough. The good old days of 2021, 22 don't apply anymore. So investors really want to see an understanding of how growth and profitability trade off each other, even if profitability is still some way off. So it's demonstrating that leadership really understands the levers to getting to that profitability. A credible path to profitability. So EBITDA margin has moved back into focus. It's not just gross margin and contribution margin. For years, EBITDA was often ignored at early stage businesses just because the numbers were really negative and you'd have thousands of percentage negative margins because growth was a priority. But that tolerance has gone. So today, investors expect a clear understanding of what the steady state business could look like, realistic assumptions around margin, and visibility on when losses start narrowing meaningfully. So you don't necessarily need to show a profitable business from day one, but rather you want to show that profitability isn't accidental or theoretical. So you know when the business is going to become profitable and you know what the business needs to do in order to get that. Unit economics and the reason behind these step changes can also be very useful here. Speed of payback. So the payback period has become a practical replacement for the long-term LTV assumptions. So rather than debating lifetime value models that rely on optimistic churn assumptions, and I've been in those discussions many times in the past, investors increasingly want to know how much it costs to acquire a customer and then how long it takes to recover that cost back in revenue. The shorter payback period equals lower risk, and in uncertain markets, that really matters. Productivity and leverage. So productivity metrics are under much more scrutiny than what they were before. Things such as revenue per head, contribution per employee, or output per team are now common questions, and this really reflects a broader focus on right sizing and operating leverage across the portfolios. So these metrics are best used internally over time. Comparing against industry averages can be misleading, as definitions can vary widely. So rather what matters is whether the business is becoming more efficient as it grows rather than the other way around. Competitive positioning, not just market size. So market size obviously still matters. You want to make sure that you're in a market that is big enough for you to operate within, especially at early stages. But as companies move from that startup to scale up, the focus can then shift. So investors then want to understand how the business is winning, where it's outperforming its competitors, and what makes its position defensible over time. So this is where your metrics start supporting the strategy, not just valuation narratives. Impact and responsibility. Finally, impact metrics aren't optional. They have been downplayed a bit in this political market. It's not as forefront as what it was, say, even just a year or two ago, but they are still important, particularly in the European market. So beyond that financial performance, investors are still asking about employee engagement and retention, diversity and inclusion, environmental and social impact. And the reason why is, along with, say, the ESG reporting that we do have to do now in Europe, it's also important for reputational value. And if there could be problems with your reputation later on, that is something the investors want to know up front. So how the business operates and the risk it carries reputationally and operationally as it scales. So what does this all mean for finance leaders? So the shift in KPIs, it's not necessarily thinking about just chasing new metrics and chucking it in for the sake of it. Rather, it's just reflecting a broader change in expectations. Investors want to back businesses that are ambitious but controlled. So growth still matters, but it needs to be supported by discipline, efficiency, and credible decision making. So for finance leaders, it's making sure you guide that story with substance. And mastering this KPI is about building a business that can withstand pressure and make deliberate choices in a more demanding environment. Now, if you want to become a confident strategic finance leader in a startup within the next 12 months, then here's your 3-step plan. The first one is to subscribe to this YouTube channel where I do weekly practical tips every Thursday to help you with your startup finance leadership role. The second one is to read my book, Financial Leadership Fundamentals, to get a clear on what's expected of you and how to show up as a leader. And the third one is to take a look and join the FLF Fundamentals course, where we fast track your growth in your career with structure, support, and strategy that works in the real world. So thanks so much for watching, and I'll see you in next week's video. Cheers.